Hi, everybody. This is Greg Gossett with Gossett Trading and Mentoring, and today is Saturday, February 22nd, 2026. Hey, I hope you're doing well. Thank you so much for coming to my weekend review podcast. I hope you are going to find it helpful and that you are going to learn something today. I hope you had a good trading week last week. I hope you're having a nice weekend, and I hope you have a great trading week next week. So, the format for today's podcast is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades, all the positions that I entered and exited last week. We're going to talk about why I entered them or exited them, what the setup was, what the confluences of signals were that initially got me into the trade. We're going to talk about how I position size based upon the current volatility of the market. We're going to talk about where I place my emergency stop, where I place my end of bar stop, where I place my trailing stop level, how I'm going to take partial profits if the market goes in the direction that I want it to, and then ultimately how I am going to exit the entire trade, whether I get stopped out or whether I get to some extreme levels and get the signals to exit the trade. After that, we are going to talk about a little bit about trader psychology. It's always the most important skill in trading, the ability to create a plan and follow it. That is traders' biggest challenges. There's a lot of good trading systems out there, a lot of good trading processes out there, but following them involves our emotions, and our emotions tend to want to get us off track and to get out of our process. And it's very important in the long run, if you want to make money, that you have to stick with your process. Then last night, I went down through my master watch list. I have identified some potential trades for the upcoming week. As I just mentioned, I look for confluences of signals, multiple signals. The more signals you have at the time of entry, the better chance you have of a profitable trade. So I have identified some potential trades for next week. They're not where they need to be at the moment. If they already were, I probably would have already taken them, but they're within striking distance of some good, solid signals. So I will go over that with you and give you an idea of what I'm looking at for next week. And like I said, I hope this is all going to be helpful. I hope you are going to learn something. If you do, I really would appreciate it if you could hit the thumbs up button. Really does help the channel out a lot, lets YouTube know that there's some valuable content here, so they'll get out and share it with more people. So let's run this U.S. legal disclaimer, get this out of the way, and then we'll get on to the current trades that I have. So hang tight, please. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, so it was a good trading week for me last week. I did have some good entries. Some of the tech stocks did go on sale, and fortunately, they did have some pretty good signals. And so, as you'll see when we go through the positions, we'll go through them all. And also, kind of interesting of note is that I'm a big proponent of trading multiple trading strategies, not just one. And in this week's podcast, I'm going to show you multiple signals that I took, not just order blocks, but we have order blocks, we have major moving averages, we have higher low V1s, V2s, we have abandoned babies, and a big tenet of my trading is trading three things: trading multiple trading strategies. So I have a variety of trading strategies, trading as many different types of markets as possible, just not tech, right? But getting out into other things, oil, gold, silver, currencies, so forth and so on. And then also trading as many different time frames as possible. I trade the dailies for my swing trades. I also trade weekly bars. Sometimes I trade monthly bars. And then, of course, I trade all day long intraday as well. But the processes that I use are called robust, which means they should work on any time frame and any market. So really that's the key. Get yourself a variety of trading symbols, trade multiple different diversified kind of markets, and trade multiple time frames. And so that's kind of what I'm going to show you today. So let's start off with Google. I did enter Google. It's been a great trade so far. I entered here on February 17th at 302.01, and we got the low market or the low bar so far in the trade. So you see this green box here. This is what I call an order block, or this is what people call an order block. And I'll explain to you why I entered, but let me first explain why this is an order block. Order blocks are great. You really should learn about them. In my opinion, it's really going to help your trading, and they're a huge component of my trading. But the order block started back here on the 17th of December, this big down green bar. So let me explain to you why this is an order block. Prior to the order block, you need several things to happen. First, you need a swing low. A swing low is a low with a higher low to the left and a higher low to the right. So you can say it makes this bar here on the 8th a swing low. Higher low to the left, higher low to the right. Okay, so we have our first swing low. After we have our first swing low, we need a swing high. Now, a swing high is just the opposite of a swing low. A swing high has a lower high to the left and a lower high to the right. So it checks those boxes, right? Lower high to the left, lower high to the right. So we need a swing low followed by a swing high. Then the next requirement is we need to have another swing low that's lower than the first swing low. So here's your first swing low, here's your first swing high, here's your swing low. Why is this a swing low? Higher low to the left, higher low to the right. So there we go. Swing low, swing high, lower swing low. Okay, once you have that lower swing low in place, you need to refer back to that first swing high. And I'll put a line here so you can first see that first swing high. Swing low, swing high, lower swing low. Now, once these three are in place, in the future, if the market goes up above that first swing high, as soon as that happens, now you've defined your order block, because once it takes out that first swing high, you have changed market structure to the upside. And you can see, was it correct? Yes, it was. It went much, much higher. But I don't buy this breakout. I wait for pullbacks after market structure has changed. So again, we have a swing low, we have a swing high, we have a lower swing low. We wait for market structure to change, which it did on this bar. As soon as this bar happens, and we take out that swing, that first swing high, now I'm looking for the lowest closing bar prior to market structure change. Okay, and as soon as this went above this swing high here on the second, I knew that this lowest closing bar, before that happened, the high and the low of this bar becomes the order block. So that's why I've highlighted the high and the low of this bar moving into the future. Now, before I get into the trade, I just want to put things in context. So we changed market structure here. Google went on to rally very, very, very strong. Now, I want you to think about this. When we are up here at these highs and we look back at this order block, order blocks are smart money. This is where smart money. But just to put it in perspective, when you look here at the highs up here at about 348, 349, and you look back to this order block, is it fair to say that smart money was buying here after the fact, after it went all the way up here? And of course, I mean, it's obvious, yes. Smart money was buying this dip because in the future, look how much it rallied. So that's why I call order blocks smart money areas. Now, then after we break structure, to the upside and define the order block, I wait for prices to come back into that smart money area. Clearly, when you're up here and you look back to the smart money area, it was smart money. I'm waiting for the price to come back to the smart money area again. Once it comes back to the smart money area, does that mean that it has to bounce? No, things can change. Yes, it was smart money in the past, but doesn't guarantee that it's smart money in the future. But in my over 30 years of experience, when it does come back to the previous smart money area, it's more likely to be smart money again. And so that is the whole theory of the order blocks of why I trade them this way. So we have this straight down move back down into the order block. Now, there are multiple ways to enter into an order block. You can buy a rejection of the high of the order block. You can buy a rejection of the low of the order block. You can buy a rejection of the 30 RSI in the order block. You can buy a rejection of a major moving average in the order block. You can create your own levels, which I'll show you in some of the trades in a little bit. But on this particular trade, the reason I entered here on the 17th of February at 302.01 is because during the day on this bar, we went under the 30 RSI intraday and we closed back above the 30 RSI at the close of the market. I always make my buying and selling decisions at the end of the day. At the end of the day, you have the smart money that comes in. They're dealing with the most money. They have very smart people, best technology, best information, and the large financial institutions move the price at the end of the day. And I consider that price to be the most valid price of the day. And so therefore, that's the most valid price of the day to make my buying and selling decisions. So on the 17th, we went below the 30 RSI during the day and then rejected it and closed back above. So this trade is a combination of an order block and a deep dip buy signal. The under 30 over 30 is the deep dip buy signal. So, okay, so that is why I enter the trade. Now, once I enter the trade, one of the probably the most important thing is how many shares am I going to buy? Well, I use a formula that has worked very well for me because it takes two things into consideration. It takes into consideration how much money do I have in my trading account, number one, and number two, what is the volatility of the market? A lot of traders, especially new traders, they don't adjust their position size based upon the volatility. If the volatility in the market is higher, I buy fewer shares. If it's lower, I buy more shares. But the formula that I'm going to show you makes it very, very simple. So I need two inputs. The first input is I take 1% of my trading account. So if I have a $100,000 trading account, 1% is 1,000. If I have $1 million trading account, 1% is 10,000, and so on, right? It works for any amount. So let's just assume that I have a $100,000 trading account times 1% is, of course, $1,000. Now, the next thing that I do is I look for the value of the 2 ATR. At the moment, it's $20.08. This moves every single day. It changes every single day. But this tells me what the volatility of the market is. When this number is higher and I divide it into my maximum allowed loss of $1,000, it has me buy fewer shares. So it's self-regulating. When volatility is higher, this number becomes larger. When it's lower, it becomes smaller. And that's it. So it always will adjust to the current market volatility. Okay, so 1% of $100,000 is $1,000 divided by 2008. This formula tells me I should buy 49.8 shares. So roughly, I'm just going to round up and buy 50 shares. So, okay. So I have my signal. Intraday rejection of the 30 RSI inside an order block, okay? I have two primary signals. I just did the math, tells me to buy 50 shares. So boom, okay, I buy 50 shares at 302.01. Now, the very next thing that I do, the first thing I do after that, remember the 2 ATR number? Well, I take my entry price minus 2008, okay? And then I put my emergency stop down here. Now we did the math. If I have 50 shares and it moves 20.08 cents down, how much have I lost? I've lost 1% of my account. That is my emergency stop. Now, if I hit my emergency stop, I just said that I wait till the end of the day to make my decisions, which is true, but there is one exception, and the exception is if I hit my emergency stop, I do that at whatever time of the day, whether that's 1 minute after the market closes or 1 minute before the market closes. If it hits my emergency stop, I'm out. And how much have I lost? 1%, because we took 1% of my capital divided by the value of the 2 ATR, so the math's there. If I hit my emergency stop, I'll lose 1%. It's not fun to lose 1%, but you can recover. But the good news is that this only happens about 5% of the time. The other 95% of the time, if I have a loss on a trade, it is not going to be because it hit my emergency stop. It is going to be because it hit my end of bar stop. So let's talk about end of bar stop. I took the trade. Why? Because it went under 30 and back over 30. So therefore, on this particular trade, if in the future it closes back under the 30 RSI, I'm going to get out of the trade. And that end of day stop is always going to be much closer to your entry point than the emergency stop. So 1% is generally going to be your worst case scenario, and your end of bar stop is going to be less than 1%, sometimes much, much less than 1%. All right. So rejection of the 30 RSI inside the order block. I position size. I entered at 30201. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 30 RSI because that's why I entered my trade. So after that, after I know my emergency stop, end of bar stop, the next thing I do is I look to the value of the 1.5 ATRs. At this moment, it's $15.06. Now I take my entry price plus whatever the value is on that day of the 1.5 ATR, and I place it above my entry. And so that is the orange line at the moment. And the reason that I do that is that if I take the trade and I'm fortunate and it moves my way, if it gets to the 1.5 ATR trailing stop level, I don't do anything. It's just that if it does cross that threshold, gets to that threshold, it puts me in what is called trailing stop level. And all that means is that now in the future, if it gets to trailing stop level, now in the future, if I have a close below a previous bar's low, I'm going to exit half of my position. So, you've heard, I'm sure you've heard that when you enter a trade and it moves up a certain amount from your entry that you want to tighten up the stops because you've had a nice trade so far. You don't want to give it all the way back, right? And so that's exactly why I placed the 1.5 ATR trailing stop level above me. If it gets there, I don't just do anything, but I am now in trailing stop mode, which means if in the future, if I have a close below previous bar's low, I will exit half. And by doing that, that has the effect of tightening up all my stops by half because I'm selling half, right? So, okay, everything I've talked about so far as the emergency stop, end of bar stop, going into trailing stop mode, these are all defensive moves. So in other words, if the market goes against me in some manner, I have to take some action, defensive action. But just like with any good sports team, you can't just play defense, you have to play offense, in my opinion. Okay, and the way that I play offense is I take a certain amount of my position off each day if the price moves a certain amount from the previous day's close. Okay, and let me show you exactly because I'm in this trade. So I'll give you a real life example. And I do this every day. I have to change it every day after the close. And so right now, all I do is I take the closing price of the day. The closing price is 315.20. And now I look for the value of the 0.45 ATR. The value of the 0.45 ATR today is 452. Again, this moves every day, but right now it's 452. So I take the closing price, 315.20 plus 4.52. My first profit target on Monday is 319.72. So let's put, and I'll show you exactly where this is, 319.72. That is my first profit target for Monday, okay? And if it gets there, how much am I going to take off? Very simple. However many shares I go into the day with, I take off 10%. So if I go into the day with 50 shares, I would take 5 shares off here at this first profit target. Now, I always place 3 profit targets. So let me put those on here for you. So we know 319.72 is our first. How is that? How do we get that? 315.20 plus the value of the 0.45 ATR. Add those two together, it's 319.72 is the first profit target. Now to get the second profit, it's very simple. I just take the first profit target, 319.72, and I add the 0.45 to it again, plus 4.52. My second profit target for Monday only is 324.24. So 324.24. Okay, there's my second profit target. And again, if I go into the day with 50 shares, I'm going to take 5 shares off at 319.72, another 5 off at 324.24, and then I do it one more time. I take the second profit target, 324.24, plus 4.52. My third profit target for the day, 328.76. And there you go. So those are my 3 profit targets for Monday. And again, how much do I take off at each level? 10% of however many shares I went into the day with. If I go into the day, if I have 50 shares right now, I take 5 off here at 319.72, 5 off at 324.24, and 5 off at 328.76. It's very easy. I just do it the night before in my trading account. I just put limit orders in, sell 5 shares here, this price, there, there. Then during the day, I don't even have to be around. If it gets there, they trigger. And what's nice is, there's a lot of advantages of, in my opinion, of scaling out into that strength. One, you're locking in partial profits. You're reducing your position size into strength, right? You're taking advantage of strength. Every single time you hit a profit target, the effect is that you are tightening up your stops just by default. On the entire trade, you're tightening your stop every single time you take something off. And then you're also reducing your position size. There's less stress on you emotionally because your position size is getting smaller and smaller. And in my opinion, it really, that fact helps you follow your process. The fewer shares you have, the less heat you have on you, the less heat you have on you, the more likely you follow your process correctly. All right. So there we go. That is how I take partial profits and play offense and defense. So, okay, I've given you the basics of the trade. Let's just review and we'll see how it happens. See how it's going so far. So again, I took the trade on 217.26 at 302.01. Why? Intraday rejection of the 30 RSI inside an order block. So more specifically, we had a deep dip buy signal inside an order block, 2 primary signals. Okay, so I entered 302.81. I position size, as I mentioned, I placed my emergency stop 2 ATRs below. My end of bar stop is very, very close. It closed back below the 30 RSI, would get me out. I placed my 1.5 ATR trailing stop level, 1.5 ATRs above. Next day, what happens? Not much. Went up a little, not enough for a profit target, but it went up. It stayed above the 30 RSI. My end of bar stop, I'm still in the trade. The next day, down a little. Okay, so no action, no profit targets, no action at all. I stay in the trade because it kept above 30 RSI. And then on Friday, boom, big day up. I believe I hit 3 profit targets yesterday. So I sold into that strength. Now, you can see I'm very, very close to the trailing stop level. Not there yet. Not there yet. So I'm not in trailing stop mode. But if Monday or Tuesday or sometime next week, it actually gets to that 317 level or higher, now I'm in trailing stop mode. I don't do anything. It just means now in the future, if I have a close below a previous bar's low, I'll exit half the remaining shares that I have that day. All right. So anyway, great trade. Obviously, 3 days. It's done very, very well. And currently I am up about 4.21% on the trade. And again, this was a combination deep dip buy under 30 over 30 in conjunction with a smart money or order block area. Okay, so there's Google. All right, let's go to Palantir. All right, I entered Palantir with a rejection this time, PLTR with a rejection at the bottom of the order block. There was an order block from the past. On the day that I entered Palantir, we went slightly under the order block and then closed back in it. That is a rejection of the bottom of the order block, legitimate primary trade. So I entered here at 129.62. I position size. I placed my emergency stop 2 ATRs below as always. My end of bar stop would simply be a close back below that order block. And look, we are so close to the bottom of that order block anyway. So if the next day had it closed back below the order block, even by a penny, I just would have been out. It's fine. You know, you're going to take a lot of losses in trading for sure. The key is you have to try to keep them small. And the best way to try to keep your losses small is entering very close to where your stop is. Well, this is very close. Okay, so rejection at the bottom of the order block, position size, entry, emergency stop, 2 ATRs below, end of bar stop, close below the low of the order block. I place my 1.5 ATR trailing stop level, 1.5 ATRs above. Next day, fortunately, goes my way. Great. Hit a profit target in the process. Okay. Next day, I hit 2 profit targets as it moved up again. So I'm selling into that strength. Also, we got to trailing stop level. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to exit half the position. Next day was down a little bit, but did not close below the previous bar's low. Next day here was our first close below a previous bar's low. After reaching trailing stop level, what do? I took off half of the remaining shares as per my rules for a gain of 4.61%. Okay, next day, during the day, was below the order block. Had it closed below here, what would I have done? I would have gotten out a half, but it tested the area below the low of the order block, closed back in it, kept me in the trade. Just by a whisker, right? Next day, opens below the order block, but again, not enough sellers to keep it down here, closed back in the order block, kept me in the trade. The next day, up a little bit. Then the next day had a nice big up move for part of the day, but of course I hit a profit target into that strength, right? As per design. And then the next day we're down a little bit, and then we were just up slightly on Friday. But let's see. So the remaining shares that I have here on PLTR are up 4.22%. But this is a good example of getting in, rejection at the bottom of the order block, going into trailing stop mode, taking off half when we have our first close below the previous bar's low. And you know what I liked here was that 3 days in a row we tested the area below the order block, but there were not enough sellers to keep it down, and it closed back in. So I'm just following the rules. Look, Monday, if it closes below the bottom of the order block, I'm simply out. If it continues to go up, I'll take take partial profits into the strength. If we get up into the 65 RSI area, 70 RSI area, then I have other rules that are going to tell me to take action or completely exit the trade. But not there yet, so I don't have to worry about that. Right now, I'm just staying in as long as we don't close below the bottom of this order block. And again, the remaining shares up 4.22%. Okay, ARK. I took ARK on the 12th of February at 68.41. Why? Okay, we have one primary signal here and we have one secondary signal. The primary signal was just like on PLTR, we rejected the bottom of the order block. Clearly, during the day, we went below the order block. We closed back in the order block. Okay, great. In addition, so I placed my emergency stop 2 ATRs below. My end of bar stops to close below the bottom of the order block, and it's almost there right to begin with. So good risk to reward ratio. In addition to that, you see I placed a green line here at 67.50. Why did I do this? Well, if we look to the left, these three bars are what is called a V2. A V2 consists of three bars. The rules are bar 2 has to go below bar 1's low, which it did. Bar 3 has to close above bar 1's close, which it did. Okay. If you want to learn more about V1s or V2s, this one's a V2, but there's also something called a V1. Go to my YouTube channel. I have a YouTube video there that explains in details V1s, V2s. But when you have a V1 or a V2, there is inherent support at halfway of bar 2 at the halfway point. That is why I entered this line here, because from the bottom to the top, this is halfway. And like I said, there's inherent support here. And on the day that I bought it, you can see it went down. Where did it get to exactly? Halfway of the washout bar of the V2. It bounced there, which was a good sign, and then it closed back inside the order block. Okay, so that is why I took the trade. So that's the combination, that's the confluence of signals. One was rejected at the bottom of the order block. Two, we rejected halfway of the V2, which also gave me some more confirmation. So I entered here, 68.41 position size, emergency stop 2 ATRs below, end of bar stop closed below the low of the order block, placed my 1.5 ATR trailing stop level above, and next day, fortunately, moved my way. I sold partial amount of my position into that strength. The next day didn't do much. Next day was up again, where I did take some partial profits into that strength because it did move the value of 0.45 ATRs. And I also touched the trailing stop level. Now I'm in trailing stop mode. All that means is that now in the future, if I have a close below a previous bar's low, I will get out of half. Next day, went up a little bit, but certainly didn't close below the previous bar's low. On Friday was down a little bit, but did not close below previous bar's low. So I took no action. The remaining shares that I have on ARKK up 4.35%. So pretty good start for the week. Again, going forward, if it continues to go up, I will continue to take partial profits. If it comes down and closes below previous bar's low, I will sell half. If it closes below the bottom of the order block, I will exit the position. If it crashes down and gets down to my emergency stop, obviously I'm going to get out there. If it moves up into the at least 65 RSI level, then I have other rules to get me out there, but we're not there yet. So the remaining shares on ARK doing quite well, up 4.35%. Nike. Okay, so Nike, I entered on the 13th of February at 62.90. No order blocks. This is what is called a higher low V2. So let me point out these two green lines to you. Here's a green line, here's a green line, okay? And these go all the way back. Green line, green line, green line, green line. Anywhere in between the green lines is considered what is called the value zone. This is the value zone. In trading, I want to buy below the value zone. I want to buy below value, sell at value. Or conversely, I want to buy in value or sell above value. Most people want up to buy above value, and then when it gets back to value, they sell. It's a complete opposite, okay? So the reason I showed you this value zone is that the rules for this particular setup is, first of all, we need the price to close below the low of the order block, of the value zone. And you can see all these days here, it closed below the value zone. So first, we need to close below the value zone. Second, we need to come back into the value zone. Well, all these bars came back into the value zone. Number 3, we need to pull back and then create a V1 or a V2. And again, if this is a V2 because we have 3 bars, bar 1, 2, and 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. So that is a higher low V2. And the reason it's called a higher low V2 is that this swing low is higher than this swing low. So that is why it's called a higher low V1 or V2 in the value zone. So I entered here 62.90. I position sized. As we discussed, I placed my emergency stop, as always, 2 ATRs below, and I need to place my end of bar stop. Well, on a V2, end of bar stop is close below halfway of the washout bar on a V1 or a V2. This is the washout bar, number 2 bar. Halfway from the high to the low is right here. This is my stop, a close below that. And you can see we're pretty close to that going into the trade. So it's a good risk to reward ratio. I placed my 1.5 ATR trailing stop level above, and let's see what happens. Next day, went my way nicely, hit some profit targets into that strength. The next day, went up again. I sold into that strength, and I also am now at trailing stop levels. Doesn't mean I do anything. It just means that now I'm at trailing stop level. Thursday moved sideways, didn't close below the previous bar's low, so I stayed in the trade. Friday, at one point during the day, it was way up here, which was great because that took me out of multiple profit targets on that strength. And then it reversed, okay? So look, I have not closed below a previous bar's low. I was fortunate enough to have those standing limit orders in the system, and it took those out and reduced my position into the strength as it went up before it reversed. Now, when we were at the high of the day on Friday, we were at 65 RSI level. Whenever I get to the 65 RSI level, then the 5 EMA, this is this thin blue line here, comes into play. So one of the rules that I use and one of the rules that I teach is that if you ever get to 65 RSI level, now the 5 EMA comes into play. Or in other words, if you get to 65 RSI and then if you close below the 5 EMA, that's the end of the trade. So I was thinking on Friday that I was going to have to get out of the trade because look how after it rallied very strong, it sold off dramatically, right? But then it was strong enough to close back above the 5 EMA. But Monday, if we close below the 5 EMA, I will get out because at one point we were at the 65 RSI level, and that's the rule. So good example of a higher low V2, and the remaining shares that I have on this trade up 3.85%. So pretty good. Netflix. All right. Well, Netflix, I entered here on the 18th of February. Why? 2 reasons. The first reason, deep dip buy. We went under the 30 RSI and closed back over the 30 RSI. Okay. So I don't usually just take under 30s over 30 RSI unless they're in an order block or there's some other confluence. And the other confluence was this long-term megaphone trend line. A megaphone trend line is when you take a swing low and then you find a lower swing low and you connect those swing lows with the trend line and the trend line goes out into the future. Once you get that third touch or rejection of that trend line, that's generally a place where the market will bounce. Of course, not always, but that's the tendency. And so on the day here that I bought it on the 18th at 77.94. I position size, I placed my emergency stop below, but the real signals was because I went under 30, over 30 RSI, and I closed back over that trend line. Hope that makes sense. So those were the 2 confluences. So entered 77.97, position size, emergency stop 2 ATRs below. My end of bar stop on this is simply a close back under the 30 RSI or a close back under the trend line, either one would be my stop. I placed my 1.5 ATR trailing stop level above. The next day it went up a little bit and reversed back down. And then Friday it did go up, surprisingly, for Netflix. All right, I've traded Netflix 3 or 4 times in the last few months. Not one single trade has worked. So, hopefully this one will. We'll see. But we'll see. But when I have the signals, I have to take them. So luckily, I was able to take some profits into the move on Friday on the way up. And so currently, right now, this particular trade, the remaining shares are up 0.99%. So anyway, we will see what happens. I'm not in trailing stop mode, anything like that. But currently up 0.99%. And the confluence was a rejection of the 30 RSI, which is a deep dip buy, and a rejection of the megaphone trend line. VIX, boy, this has been a wild trade, but a good example. Really, I think a good teaching example. So I entered here VIX on January 15th at 26.29. Why? Order block. Let me point out the order block. We have a swing low here. We have a swing high here. We have a lower swing low here. And then on this day here, we took out the first swing high. So as soon as I take out that first swing high, after I have a swing low, swing high, lower swing low, take out the first swing high, it changed market structure to the upside, and it let me define the order block. What was the order block? Lowest closing bar before market structure change. Okay, so I didn't buy the breakout here, but it did define the order block. Next day goes up again. Great, I'm not in the trade. Next day it comes back down. Now, I told you before that with order blocks, you can have a rejection of high of the order block, low of the order block, or rejection of some kind of moving average or level inside the order block. Sometimes you don't have any, in which case I make my own. And so I placed a line here, 2610, as my level. Why? Well, whenever you have a big up bar, okay, and here's the bar that I'm keying off of. Whenever you have a big up bar, has to be up bar. Halfway of that is going to provide some inherent Fibonacci 50% support. So that is why I drew that level. And so after we changed market structure to the upside, we came back down. On the day that I bought it because it rejected that key level of 2610 and closed above it. So I entered at 26.29. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop initially was just a close back below 2610. Look how close I am to that level to begin with. So it's a very good risk to reward ratio. Okay. So next day it goes up, and then the next day we have the rocket ship to the moon. Now remember, I sell into the strength. I normally place 3 limit orders every day, 3 profit targets. But if it exceeds 3, I place them in manually. Well, this hit 8 profit targets on the day. So I got out of 80% of my trade into that strength. But I kept a little, right? Now, clearly we got to trailing stop level. The next day we closed below the previous bar's low. What do? Take half. And I did take half off for a gain of 1.76%. But remember, the previous day I sold 80% into this. Okay, so going forward on the trade at this point, I'm waiting for a close back below the low of the order block. My initial stop was a close back below 26.10, but because I sold 80% and then I took another half of the remaining, I hardly had any. So I basically switched the trailing stop level because I had so few shares to a close back below the order block, but it never happened. So next day it went up, took a little profits. Then we kind of went up a little bit, profit target here, and then multiple profit targets into this move up. Then we pulled back again. We pulled back right to that level, the 2610 level. It accelerated, went up again. I don't have a lot of shares left at this point, but I still have enough to scale out as it moves up. Scaled out here, scaled out here, scaled out here. Then we pulled back. Every time we pull back to the order block, but nothing lower. Then we had some moves up, took some profit targets here, took another profit target there, took another profit target on Friday at its high before it reversed. So this has been a very interesting trade. The remaining shares that I have on VIX are up 7.33%. But, you know, vis-a-vis the market, whenever we get up here on VIX, that's usually the low of the market. Whenever we come back down to the smart money area, the market generally goes back down. So something to watch. You know, at this point, we have room for the market to continue up with the VIX coming back down into the order block. But if we do get back down into this order block, that's going to be a little bit of a red flag, in my opinion. I could be wrong for the market, but historically over this last month, that's certainly the case. Whenever VIX gets extended up here, the market tends to rally. Whenever VIX comes back down into the smart money area order block, the market tends to fall. So, you know, keep that in mind, that if the market does, or if VIX does come back down into this order block, you know, based upon recent events, that generally be some kind of high in the market. But everything could change, and VIX could continue to go down, and the market can continue to go up. Who knows? But I'd like to look at VIX to give me some kind of a barometer for where I'm at with the markets. But regardless, the end of, or the remaining shares that I have on VIX up 7.33%. Silver, really good trade on silver this week. Incorporated two primary signals. The first primary signal would be a rejection of the high of the order block, and then an abandoned baby. So the green block here, and I've talked about this order block for multiple weeks about silver. Back here, we have a swing low, we have a swing high, we have a lower swing low. We change market structure. This defined the order block here on the 31st. Of course, when silver was way up here and you look back to that order block, can you safely assume that smart money was buying here when after a month we're up here? Yeah, of course, right? So again, this is the smart money area. I'm looking for silver to come back to the smart money area. And, you know, with all the chaos that happened with silver, look where silver stabilized in the previous smart money area. It stabilized in the order block. So I bought silver on the 18th at SLV 69.80. Why? Well, the previous day we were in the order block, and then the next day we close back above it. That is a close back above the order block. Now, normally I would not take that trade just based upon that. But we have what is called an abandoned baby. An abandoned baby consists of three bars: bar 1, bar 2, bar 3. The key with abandoned babies is that bar 2 is a gap down from bar 1. You can see bar 1's close, and then the next day we gap down overnight. Okay, that's bearish sentiment, right? It was bearish. We gapped down. However, the day that I bought it, it gapped up. So that was a very fast and quick change in sentiment from the previous day gapping down to the next day gapping up. When that happens, everybody was very bearish to very bullish in a very short amount of period of time. And when that happens, there's a lot going on under the hood in this particular market, right? It's hard to explain why, but that's why abandoned babies, bullish or bearish, are so powerful. We gap down and then we gap up. So the confluence of the signal for the day was we had two signals. We had a close in the order block. Next day we closed over the order block. That's one primary signal. And then we had the bullish abandoned baby, gap down, gap up. So I entered here 69.80. Now, there are several ways I could manage this trade, but generally with abandoned babies, I change up the management of this trade a little bit, and I make it very easy. Okay, so I entered here 69.80. On this particular strategy with abandoned babies, I place a 2 ATR stop below, emergency stop as always, but that's it. I only have a 2 ATR stop. But to the upside, I place a 4 ATR profit target. So I have a 2-to-1 risk to reward. This is kind of a set it and forget it trade. I'm not going to take on this particular strategy only. I'm not going to take partial profits. It's a set it and forget it. I'm placing a 2 ATR stop below. I'm placing a 4 ATR profit target above. If I'm wrong and I hit my emergency stop, I lose 2% of my account. If I'm right and it hits my 4 ATR profit target, I make 2%. So I'm risking 1 to make 2. But in my experience with trading Band of Babies, about 70% of the time when I do this, 70% of the time I hit my 4 ATR profit target. 30% of the time I hit my 2 ATR stop loss. So pretty good odds, right? So again, rejection of the high of the order block and a Band of Baby. I got in on the 18th at 69.80, and so far this trade doing quite well, up 9.25% on the trade in 2 days. So good example. When I took this trade, I was like, oh, this is good for the podcast. This is going to show a combination again of an order block trade plus a different strategy, which is the bullish Band of Babies. So up 9.25% on the silver trade. And then I did take a signal on Friday on Mastercard. Okay, why did I take this trade? Well, I could have taken this trade on Thursday with the rejection of the bottom of the order block. And one of my students, Vivek, actually did. So nice job, Vivek, on taking that. I waited until yesterday to take the trade at 526.26. Why? Well, again, during the day, we did go below the low of the order block and then close back in it. So that is a legitimate trade just from there. But I also incorporated this trend line into the trade. So this is not a megaphone trend line. This is more of a conventional long-term trend line where, wow, this trend line is so long. We have this swing low here, and then we have this higher swing low here. So if you connect those swing lows, that will give you the support going forward of the trend line. So if I zoom in here, you can see it connected to that trend line. Here's the trend line. On the day that I took the trade, I had 2 signals. We rejected the bottom of the order block, closed back in the order block, and then we also rejected that long-term trend line because the previous day it closed below the trend line, and then on Friday it closed back above the trend line. Okay, so that's why I took the trade. Basically completely break even on the trade because I just took it at 526.26. So of course I position size, I placed my emergency stop 2 ATRs below, and my end of bar stop on this particular trade, I could make, I have 2 options. It could be a close back below the low of the order block. That would be one option, and a close back below this trend line. That would be another option. Either one of them are fine. They both have their pluses and minuses. I think what I'm going to do is a close back below the low of the order block because my student Vivek, I know that's his stop, so I'll just get in the same trade at this point with Vivek and close back below the low of this order block. I will get out of the trade. But so far, I like the signal. I like the setup. And on this one, completely break even. So there you go, everybody. Those are the current open positions that I have on the daily charts. Great trading week. I felt I was very thankful that my positions did very well. But we have to put our work into the trade, and I try to be as particular and picky with my trades as possible. Doesn't mean they're going to work out, but I'm going to do what I can do to get into the trade. After I get into the trade, it's up to the market. I can't do anything, but I do have control over what I get into, and I wait for confluences, multiple signals to get into the trade. And as you can see, it's worked out pretty well. So in addition to trading weekly bars, I also daily bars. I also trade weekly bars. So I have 2 of those. I got stopped out on one of them, but I'm still in UUP. Again, these bars are weekly bars. Every bar is a week. Weekly bars close on Friday, so I have to make my decisions on Friday. I've been in this trade for quite a long time on the weekly bars. I got in this trade on 7/11/2025 at 26.23. Okay, let's look and see why I got into the trade. Two reasons, two primary signals. The first signal was the deep dip buy. We closed under the 200-week moving average, closed back over the 200-week moving average. That's a legitimate signal. That's one. The second signal that I took was a rejection of the high of the order block. The previous week, we were in the order block. The next week, we closed above the order block. So there's the two confluences. Close under, close over the 200-week moving average, close in, close above the order block. Those are the two signals. I got in 26.23. I placed my emergency stop 2 ATRs below as always. My end of bar stop on this particular trade is simply a close below the 200-week moving average. I placed my trailing stop level 1.5 ATRs above. Next week went my way, thankfully. Hit a profit target, sold into the strength. Next week down, tested the 200-week, but closed back above, kept me in the trade. The next week, big week up. I hit multiple profit targets into that strength, and then also got to trailing stop levels. So now I'm in trailing stop mode. Next week down a little bit. The next week we had our first close below a previous bar's low after reaching trailing stop level. What do? I took off half of the shares that I had remaining for a gain of 0.49%. Then we moved sideways for about a month. This bar here was interesting because during the week we went below the 200 week, but yet it closed back above, kept me in the trade. Had it closed below the 200, I would have gotten out of the trade, but it kept me in the trade. And I'm certainly glad because we had a move up for several months at that point. So it kept me in the trade. The next week we went up, hit a profit target into that strength. Next week, nothing. Next week, up again. Profit targets into that up move. Couple weeks sideways, nothing. Next week, up again. Sold into that strength. And then at that point, we kind of moved down. We had another week up here where I took another profit target. Then we moved down. Then we moved up. I hit a profit target here. Then we moved down dramatically. This week here, I thought for sure I would be stopped out of the trade with a close below the 200. Yet it closed back above, kept me in the trade. Okay. So then we went up. Then last week we tested the 200 again, but then this week we went up again and I hit two profit targets into that strength. So as long as we stay above this close above this 200 week moving average, I will continue in the trade. If it continues higher and we get to a 65 RSI level, then other rules come into effect for me to exit the entire trade. But anyway, this trade's been doing okay. It's up 2.88%. And then last but not least is IGV. This is a weekly trade that I took here on 2/6 at 882.46. Nice signal, good signal, multiple signals, rejection of the 200-week moving average, and a rejection at the bottom of the order block. Everything I could ask for in a trade. So I got in 82.46. I placed my emergency stop 2 ATRs below. My end of bar stop, a close below the 200-week moving average. After I took the trade, the next week it went up. Thankfully, I was able to hit a profit target into that week. So it reduced my position size a little bit. And then this week, look, the 200-week moving average is 80.79. Where did we close? 80.78. So we closed below the 200 by 1 penny, but that was my stop and I got out of the trade. So I did stop out of the trade. I lost 2.36% on this particular trade. But look, next week, it could close back above the 200 again. And if it does, I'll probably take the trade again. But this one was a losing trade of 2.36%. So there you go, everybody. Those are my open daily positions. I showed you the IGV, the weekly position that I got out of, I got stopped out of, and then the UUP weekly position that I am still in. So anyway, hopefully that was helpful for you to see and to learn, kind of see the setups and the entries and how I'm managing those trades. Before we start taking a look at the trades for next week, let's spend a few minutes and talk a little bit about trader psychology, because I'm such a huge fan of trading psychology and I know how important it is. So let's take a look. Okay, so this week's Trader Psychology comes from my good friend Thomas Payne. Follow Thomas at Trader T Payne. You know, the interesting thing about Thomas is that he started a career in trading after he was a scientist. And so he was a scientist for many years, and he took the scientific method, his propensity for everything, you know, that in his job, being very scientific, he took that same thinking into trading and made trading very, very scientific, which I think is great. And so let's see what Thomas has to say here. A casino doesn't need to know which cards will be dealt next in order to make money. It repeats its edge over and over, winning and losing, with no concern over the uncertainty. This is how you must approach trading. Find your edge and don't be so needy. Kind of laughed on that part. But what Thomas is saying is true. A casino has a built in mathematical edge in all of their games. They know that as the longer those games are played, that mathematical certain edge is a certainty and will express itself in the casino making money, right? That's why the more hands that are dealt, the more times the roulette ball is rolled, the more times the dice are rolled, the more money the casino makes. It is the exact same thing in trading, everybody. If you have a mathematical edge in your trading, the more trades that you take, if you have a setup that has an edge, the more money you will make. You know, and I use this analogy with many people when they ask me about trading. Greg, isn't trading gambling? And right, you guys get it, right? You get that with friends and families when they don't quite understand. I said, well, listen, if you own a casino, are you gambling? And they're like, well, no. I mean, you are, but you're not because, you know, they have an edge. I said, it's the exact same thing with trading, everybody. You know, it's the exact same thing. You know, a casino, if somebody walks in, I mean, if I go in and play 5 hands of blackjack and I win 5 hands, the casino doesn't, you know, clutch their pearls and think, oh man, we better quit. Greg's won 5 hands of blackjack. They don't care, right? They know over the long run that they're going to get me and they're going to get everybody else because of the edge. It's the same with trading. If you have a setup that has a mathematical edge, in the long run you're going to make money. So that's why really I don't like to lose money. I don't like to have losing trades, right? I mean, I share them here on YouTube, right? Most people don't have to share their trades, but I don't care because I know I'm just like the casino. I just look at everything that I do like a casino. Yes, I'm going to have losing trades, but I know in the long run I'm going to make more money than what I lose. I mean, I've been trading for over 30 years. That is my income. That is what I do. You know, for some a newer trader, they may not realize that. They don't have the confidence yet. But I've been doing this majority of my life. So I know. So I know I'm going to have losing streaks. I know I'm going to have drawdowns, but I know in the long run I'm going to get the money, right? And so get yourself a good process, whether you learn it from me or you learn it from someone else. But the key is you need to follow the process. If the people in the casino, you know, didn't take the money when they were supposed to, or they paid out the wrong amount of money, that would certainly affect the casino's profit and loss. That's why they have the dealers and they have the pit bosses looking over the dealers and they have the eye of the sky looking over the pit bosses, right? They are being monitored at all time to make sure their process is followed. And it's the same with us in trading. Unfortunately, most traders don't have anybody looking over their shoulder, making sure they're doing what they're supposed to do, right? And I think that's one of the weaknesses in trading. I think if somebody had somebody to help them do that, it would make a big difference. So, but at this point, it's up to you. Follow your process, whatever it takes. Share the trades with your family, your friends, your husband, your wife, your brother, your sister, girlfriend. Doesn't matter. If you know somebody's looking over your shoulder, you're going to follow your process better. And following your process is what's going to get you the money in the long run. So thank you, Thomas Payne. I really appreciate it. Hope you're doing well. And thanks for that great post. All right, everybody, let's take a look at some potential trades for next week. I've got some good ones, both on the daily timeframes and the weekly timeframes. So we'll start with the weeklies. So look, here on the weeklies, I'm going to share with you 9 potential setups for next week. Now, I say this every week, but listen, there is a possibility that all 9 of these setups could happen on the same day. So am I going to jump in? Am I going to buy all 9 of those? No, I only buy 1 trade per day. I don't care if I have 100 legitimate signals. I'm going to have to narrow it down to the best one. So how do I do that? I look at multiple things, right? First of all, how many signals do I have per trade? If one trade gives me 1 entry signal and the other trade gives me 2 entry signals, well, which one do you think I'm going to trade? I'm going to take the one that has 2 signals over 1. However, if we talk about an extreme, maybe something has 5 entry signals. Wow, boom, got to get that one. But maybe that one has moved so much that day that now the risk to reward ratio is not good. Okay, now we have to factor that into the equation. So I factor in confluences. How many entry signals? How many confluences? What's the risk to reward ratio? I look at higher time frames. If I'm trading the daily, I like to look at the weekly to get additional confirmation. I look at relative strength of the market. How was that particular market doing relative to the rest of the market? So, this is what I teach, and this is what I teach my students, how to narrow down to the best trade, right? And so here I have 9 potential entries. I don't know the future. If I could show you in real time, I think that would be helpful, but you have to take everything into uh, uh, you have to factor everything into the equation to pick the right one. And like I said, that's what I teach my students. And just so you know, I do teach students all over the world. I teach a one-on-one course. It's a 20-hour one-on-one course. I teach my students 2 hours a week for 10 weeks. I teach them all the different trading approaches that I use, all the strategies, all the nuances. We do a lot of simulation trading. I ask my students a lot of questions. It's very important for me that when a student graduates with me for the 20-hour course, that they are really a good trader. And I have turned out some great traders around the world. I really have. I'm so impressed with a lot of them. And so if you would like to become my student and do this 20-hour one-on-one course with me, I think the very best way to learn anything is one-on-one with your instructor. Then you can ask your instructor as many questions as you want. We're together for 10 weeks, so we see a lot of changes in the market and how to interpret them. So if you would like to do the 20-hour one-on-one course with me, I'd love to have you as a student. I will teach you everything that I know. My email is in the link of this YouTube video. Just send me an email. I like to have an initial call with prospective students. It's not a sales call, I promise you. I just want to meet you, learn more about your trading challenges, your goals, and it's a really good time for you to ask me any questions about the format of the course. So send me an email. Love to talk to you. And like I said, I'll teach you every single thing I know about trading, and I love to see my students succeed. The course does cost $2,000, but I think it's a really good investment. You'll learn a skill that you can use the rest of your life. As an alternative, if you like online courses, I have a really good online course at udemy.com. The link's in the description. And I teach you the deep dip buy stock trading approach. It's 9.5 hours of video. It's really good, and it's a really good place to start. And it's very affordable. It's somewhere between $30 and $50. They set the price, I don't. So like I said, if you'd like to study with me one-on-one, or you'd like to take the online course, the links to both of those are in the description. So anyway, love to hear from you. And so let's get on to the potential trades for next week. So this is AMD. So I've been following AMD for a while. I had a great trade on AMD, if you remember from the podcast here on the 12th of January. I bought it here. Rejection of the high of the order block, rejection of the 100-day moving average. Look at that trade. That was a fantastic trade. I entered here, or I exited right there. Good spot. Well, look, now we are back down into the order block from the past. Okay, so if you remember back during the podcast earlier today in the podcast, so there's multiple ways that you can enter a trade in an order block: a rejection at the high of the order block, a rejection at the low of the order block. But in this particular order block, we don't have any moving averages, and we're not near a 30 RSI. So I have designated this line here, 196.80, as my key level. And why? Well, here's a V2. Bar 1, 2, 3. 2 goes below, bar 1's low, bar 3 closes above. Halfway of that washout bar, the 196.80 level is the key level. Now, you can see back here on the 17th and 18th, it did reject it. It rejected it here or rejected here. Could I have taken the trade? I could have, but on those particular days, I had better setups. And so I didn't take this, right? So, but going forward now, that's what I'm looking for potentially for AMD would be a rejection of the 196.80 level. Maybe it consists of a V1 or a V2 at the same time that does that. That'd be great. Improves the quality score of the trade. So what I'm looking for on AMD is a rejection, another rejection of 196.80, or a rejection of the bottom of the order block right there at 39.37 would also be a legit. So rejection of 39.37 or a rejection of the 196.80 level is what I'm looking for at the moment for next week on AMD. Boeing. Okay, this is a little bit different of a trade that I usually show you on this particular podcast, but you know, I took a trade, a day trade, and I'll see if I can show that to you here in a minute, on the Qs based upon this same principle. But let me show you here the gray line and the black line. The gray line is the 50 and the 200-day moving average is, or the black line is the 200. Okay, when the 50 crosses over the 200, that is what's called a golden cross. Everybody gets really excited about a golden cross because they think that's very bullish. And listen, long term it can be, but in my experience, when you have a golden cross, which everybody gets excited about, I don't get excited about it, because usually when that golden cross happens, at least in my experience, the market goes down. Well, what happened when right, it crossed? What did it do? It went down, as it usually does. But when the 50 crosses over the 200, what I have also noticed is when the 50 crosses over the 200, if it starts to go down and the price gets back down and rejects the 200, it usually bounces there. Not all the time. But again, the setup is you have to have the golden cross, and then the first rejection of the 200 after the golden cross happens, that's the key level. So I am waiting for a simple rejection of the 200-day moving average. There's not an order block, there's not anything else, but it does have the golden cross prior to that happening. That's the confluence. So I drew the green line here. In addition, you have the 200-day moving average dovetailing right there with the negative third ATR channel. Those are two confluence areas as well. So again, we have the golden cross. The setup is after you have the golden cross, the first pullback to the 200-day moving average and rejection of the 200-day moving average after the golden cross happens. Now, let me show you real quick the same thinking on the Qs. Look, golden cross. Anything to be excited about? Not really. It went down. However, after the golden cross happened, the first rejection of the 200-day moving average, there you go, right? The golden cross happened. This is the first rejection of the 200. Look, that was a nice little day trade for me. But again, the 50 crosses the 200. If it goes down, rejects the 200, close under, close over the 200 there. That is the key area. We rallied from there, then we pulled back, tested the 200 again, and then moved up here. I sold my position up in here. But again, this is on the 5-minute, but I'm just showing you the example. Golden cross happened. Am I going to buy it? Heck no, because generally I know it's going to go down, and it's exactly what happened. But again, the first rejection of the 200 after the 50 crossover, that's the area. And you can see that was a nice day trade for me on the Qs. So back to Boeing. Maybe that puts it into perspective a little bit, right? Golden cross, as soon as that happened, everyone's excited, super bullish, right down. But the golden cross happened. I'm just waiting for rejection of the 200 now that the cross has happened. So it may get there, it may not. If it doesn't, fine. If it does, I'll consider taking it. IWM. All right, I've talked about this for a couple weeks, haven't got there. We have a order block, swing low, swing high, lower swing low, market structure change, defines the order block. What's living inside the order block? Yeah, 50-day moving average. I like it. In addition to that, I drew a line here at 258. Why? Here's the V2, halfway the washout bar of the V2, halfway is the support. So I'm looking for a rejection of either the 50-day moving average, which is 258.64, or rejection of the halfway of the washout bar of the V2 at 258. So those are the two levels that I'm looking for. And of course, if it rejected the bottom of the order block, I'd be interested in that too. The rejection at the bottom of the order block is 255.05. CarMax. All right, so a lot of times, you see the green bars that I have, the green order blocks, those are bullish. Well, this is a bearish one. When they're red, they're bearish. So let's talk about a bearish order block. What makes a bearish order block? Bearish order block is just the opposite of what a bullish order block is. You have a swing high, then you have a swing low, then you have a higher swing high, then you have a market structure change to the downside. So let's look at this. When we're down here and we look up here, was that smart money buying? No, it was not. It was quite the opposite. So if the market rallies back up to that area that was unsmart money, I'm going to look for a short. Now, look at this bar here on the 22nd, big down bar. I've talked about big up bars having support at halfway. So if we have a big down bar, you're going to have resistance at the halfway. Well, look, that level is 48.40. Halfway of this big down bar is a resistance level that was also in a previous unsmart area. So what I'm looking for on CarMax would be a short if next week we reject the 48.40 level. It may not get there. I may not have the trade, but if it does reject the 48.40 level and give me a good risk reward ratio, I will consider getting short there. Of course, if it rejects the high of the order block, I would also consider getting short there. The high of the order block is 49.08. So I'm looking for a short level or for a short trade on KMX with either rejection of 48.40 or a rejection of 49.08. And I would use the 48.40 level as my end of bar stop, or the high of the order block as my end of bar stop at 49.08. Meta. Okay, I've talked about Meta for a while. I know exactly where I want to enter this trade. And really two levels, although it's moved from here. So I'm basically going to go with this level here, the 618 level as my entry. So why? Well, I talked about abandoned babies. Abandoned babies are considered 3 bars. You gap down, then you gap up. But there's also something called a island reversal. An island reversal is the same as abandoned baby. It's just that it has 2 or more bars. You can see we gap down, then we had a bar sideways, then we had a gap up. That leaves these 2 bars. It could be 2 bars, 3 bars, 5 bars, doesn't matter. But at this point, it's 2 bars. So, and you can see we went very bearish to very bullish, and then we took right off from there. So it was a correct signal. When you have an abandoned baby or you have an island reversal, the high of that abandoned baby or the high of that reversal, the baby or the island reversal, there is a lot of inherent support there. So I know that there's going to be a lot of inherent support at 618. It doesn't have to hold, but I just know that, odds wise, there is support there. So if Meta, and kind of looks like it's taking off from here, but if Meta for some reason does come back next week and reject that 618 level, that would very likely be a potential entry for me. And at that point, because it's an island reversal / abandoned baby, I would enter the trade with a 2 ATR stop below me and a 4 ATR profit target above me, just like I showed you on the silver trade that I took. But it does have to reject the 618 level in order for me to get interested. Microsoft, so weak, so weak, so weak. Well, this one's pretty easy. We have a long-term trend line that we touched, we bounced, we have not come back to test it. We're at a 32.35 RSI level. So if this happens, I really would be interested in this trade. But what I'm looking for going forward at this moment on Microsoft would be an under 30, over 30, a rejection of the 30 RSI, either day to day or intraday. At the same time, we have a rejection of this long-term trend line. That would be a really good high probability trade, but we haven't had it yet. So just to be clear, I am looking for, we're at 32.35, so I'm looking next week to go under 30 and then back over 30, either intraday or day to day, and at the same time going under that long-term trend line, rejecting it and closing back over. I think that would be a very good high probability trade. Although it doesn't have to work, right? It doesn't have to work at all. And if it does do that, and then if it goes under the trend line, over the trend line, under the 30, over the 30, sure, very likely I'll take the trade. But if it closes back under the 30, no questions asked, I have to get out of the trade. Pfizer. All right. All right, well, Pfizer's had a nice little run here, and it is having a pullback, which is normal, but we have an order block. Swing low, swing high, lower swing low, market structure change. When you're up here, you can confidently say there was some smart money buying down here, so I'm waiting for the price to come back to the smart money area. So what am I looking for? 2 levels on this, well, actually, I should say 3 levels. First level is simple rejection of the 50-day moving average inside the order block. The 50 is at 25.69. That's one. The second one would be a little lower, 25.63. Why? Halfway the V2. Here's bar 1, here's bar 2, here's bar 3. 2 goes under 1, 3 closes over bar 1's close. The inherent support is going to be at halfway the washout bar at 25.63. And they both the 50, which is 25.69, resides in the order block. Halfway of that washout bar, the V2, resides in the order block. So just to be clear, rejection of 25.69 would be one level, and then I would use the 25.69 as my end of bar stop. A rejection of 25.63 would be another level. I would also use the 25.63 as my end of bar stop, or clearly the bottom of the rejection at the bottom of the order block would also be legitimate. The bottom of the order block is 25.26, and I would use the 25.26 again as my end of bar stop. Let's go to bonds, TLT. All right, TLT formed a bearish abandoned baby. Just the opposite. We gapped up, very bullish, very next day gapped down, very bearish. So very quick change in sentiment from bullish to bearish. Did I short here? No, I didn't. When the abandoned babies happen, again, I'm looking for a rejection. If I'm bullish, I'm looking for a rejection of the high of the baby. Here, I'm looking for rejection of the low of the baby. That's the red line here, 89.76. You can see Friday, we almost got there and then sold off. So I'm looking on TLT, had a nice run. I'm looking for a short of TLT if we reject 89.86, or in other words, we go up, we get to it or above it, and then close back below it. If that's the case, then I'll place a 4 ATR profit target below and a 2 ATR profit target, 2 ATR stop above, because I was looking for a short. So I'm looking for a short of 89.76 with the 4 ATR profit target below and a 2 ATR stop above. And then last but not least is Walmart. All right, Walmart's had a really good run. It is coming back, but we have a nice order block here all the way back on 1.7. Swing low, swing high, lower swing low, market structure change defines the order block. Again, if you look up here, And then you look back here with smart money buying here. Yeah, clearly they were because it went all the way up here. So now I know where the smart money is. I just need to wait for it to come back to there, right? It's not there yet. I don't know if it will get there. But what I'm looking for on this particular trade, really, I'm just looking for a rejection at the bottom of the order block, because if I reject the bottom of the order block, it will also be a rejection of that 100-day moving average. So, I'm not holding out a lot of hope that Walmart's going to get there next week, but if it does, I want to be ready and I want to know what I'm looking for. But really, I'm looking for rejection of the bottom of the order block or rejection of the 100-day moving average, which is at 111.98. So those are the dailies. Let's quickly look at the weeklies. I have a couple of those. I've got 3 of them. Again, these are weeklies now. All right, here's IBM on the weeklies. Way up, way down. We have an order block here. Swing low, swing high, lower swing low, market structure change. This was the order block. Going forward, look, very clear. We have the 100-day weekly moving average at 234.42 inside the order block. Is it going to get there? I don't know. If it does, it's probably a decent place to, at least for me to take a try at it with a good risk to reward ratio. So on the weeklies next Friday, if we have rejected 234.42, I would consider that. In addition, rejection at the bottom of the order block at 230.76. Talked about Microsoft on the daily already, but on the weekly, very easy, simple look here. Look, these are weeklies. We have an order block on Microsoft all the way back to January, February, March, April 4th. And then we took off from there. Clearly that was smart money because months and months we went up. Well, now we're coming back to that smart money area. So I'm looking at 2 different locations. I'm looking for rejection of 373. Oh, excuse me. Yeah, disregard what I said there. I'm moving it back. I moved it back down a little bit. Yeah, they both dovetail exactly at the 200. So the 200 is at 370.05. If we go down on the weekly bars next week and reject basically 370.05, excellent place to potentially take the setup for me. My line in the sand will be the 370.05 level because it's a 200-week moving average inside a previous smart money area order block. Yeah, this one's pretty clear. I don't know if it's going to get there, but if it does, guaranteed, very likely, if it has a decent risk to reward ratio, I would get it. So look, I'm looking at Microsoft 2 levels, 370.05 on the weeklies, or if we go to the dailies, I'm looking for something much closer with an under 30, over 30, and a rejection of the trend line as well. All right, let's go to RBLX on the weekly. This one's pretty easy. We have a swing low, we have a swing high, we have a lower swing low. The stock takes off to the moon. Was smart money buying here? Yeah, it clearly was when it went up to here. Well, look, we're getting back down to those levels right now. Are there some key levels inside that order block? Yeah, there are. There's the 250-week moving average, which is 58.94. We're pretty close. We're 62. Or we have the 200-week moving average in this order block as well at 54.08. So really what I'm looking for is either rejection of the 250 at 58.94 or rejection of the 200 at 54.08. Doesn't mean they're going to work, but they're good confluences, major moving averages inside an order block. So listen, if you have any questions about anything I mentioned today, please let me know. I'll do my best to reply and to answer your question. I hope you have a really good weekend, the rest of your weekend. I hope you have a good trading week next week. If I can help you with anything, with teaching or consulting, love to help you. I help a lot of different traders in a lot of different ways in consulting capacity, and in addition to that, of course, into teaching. So if I can help you, please reach out. Love to talk to you. I always like to leave off, please try to go out and do something nice for somebody today if you have the opportunity. I mean, if you have the opportunity to help somebody out or be nice, one act of kindness, just do it. It's going to be good for them. It's going to be good for you. It's just a win-win situation all the way around. If you have the opportunity to, make some kind of act of kindness for an animal that needs help or something like that. I'm a huge animal lover. And so, they appreciate acts of kindness just like we do. But again, I appreciate you listening to this. I hope you found it was helpful. And if you could hit the thumbs up button or subscribe, I would really appreciate it. But God willing, I will see you next week, everybody. Thanks a lot. Enjoy the rest of your weekend, and I'll talk to you later. Bye-bye.
Required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.